Well, we got our surprise 100 basis point drop in bond yields this week, but that was in England. Stock market, not a good quarter, not a good year, not a good 52 weeks, and too many of these comparisons are harkening back to 2007 and 2008. Too close for comfort for that matter. Looks like we need to talk about the environment again, being bees, trees, dirt, and flowers, because what's gone on in Florida this week, all of us are going to pay for it. And as the Fed is trying to fight inflation with every tool they have and every tool they don't have, I think an inflation number they should look at is payment inflation when it comes to housing. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you had a great week. All right, well, the Bank of England this week came out and cut their rates, going in the face of every other central bank in the world. I believe this is the right move to do because they don't want to throw the baby, their economy, out with the bathwater, inflation. I understand they did this to protect their currency, but I think it's a great call, whether it's on purpose or not, as they recognize the inflation they're trying to fight isn't happening through the mechanisms they're trying to fight it with. So they went ahead and had a surprise rate cut, and their bond yields, their equivalents of ours, went down about 100 basis points. Like I discussed last week, I didn't think something was going to happen this week, but there's no support, technically speaking, for these elevated levels on the Treasury yield. So any crack in the system, like I said last week, you'll see a 50 or 100 basis point move down. And here at home in the U.S., we actually had a 30 basis point reaction since the Bank of England did what they did. And that wasn't even us that did anything. So I bet you a big reaction over here to something. We'll see that 50 or 100 basis point drop in our Treasury yields literally overnight. And like I said, globally, central banks are following our Fed to fight inflation that they can't fight. We're going to see how this ends. But I think whether they are right or wrong or the reason they did it, I think the Bank of England definitely had it right this week. All right, a quick update on the markets. Not pretty at all. I'm just going to speak on 52-week basis levels. The Dow Jones down 22% roughly. Bear market definitely. NASDAQ 34% down from its 52-week high. Bear market. S&P 500 25% from its all-time high. Bear market. Oil, and here's a funny one for us here in California. A barrel of oil is down about 33% or so since its peak this year, yet we're still paying $7 a gallon for gas. Haven't been anywhere else in the country this week, but someone needs to explain that to me. I know California's got some different things, but that seems a bit extreme. And if this was going on in the rest of the country, I bet you we'll see gas prices come down this weekend or on Monday naturally, because I think these oil companies are trying to juice their earnings for the third quarter when they report. These last few weeks of the quarter, I think they've definitely jacked us up on the price of gas. Bitcoin, which is my favorite thing in all markets because I don't understand it, down 60%. Here's one that's actually held up in the face of everything, almost in bear territory. Gold's down about 18% from its 52-week high. Your traditional flight to safety and quality. I bet you this is going to work the same as bonds when people realize that the bond yields are a great return. And the 10-year Treasury, on a year-to-date basis for that matter, I'm going to keep this up 220 basis points. And we've all seen that translation, of course, in mortgage rates. And referring back to 2007 and 2008, every time I read something or turn the TV on, they are comparing these numbers I just gave you to what was happening in the markets in 2007 and 2008. And we all know what happened shortly thereafter. All right, moving on to the biggest threat to all economies and our existence as human beings, the environment. Trees, dirt, water, flowers, and everything else out there. Florida's problem this week is bad. They've called it biblical. They've called it once in every 500 years. Whatever the case is, it's bad. And I feel bad for everybody, and I'm praying for everybody's survival down there, of course. But here's the thing. Whether you live in Florida or not, you're going to pay for this because who do you think's going to want to insure anything in Florida now after what happened here? There might be some insurance companies that pulled out a long time ago that are really happy today, not collecting those premiums because their payout is probably going to break a few insurers. and there's going to be a ripple effect, no pun intended, to the rest of the country, as insurance rates will definitely go up. And these insurance companies might start factoring in other things in other areas that could be natural disasters because of climate change, and continue raising our insurance premiums, along with inflation on everything. But who knows if any insurance company is going to want to insure. I want to see who's got the guts to jump back into that Florida market after what's happened this week. And I said this, I don't know, a month ago or something. If you can't go outside, you can't have an economy. About a month ago, I was talking about how hot it was. Can't go outside, can't have an economy. Now in Florida, you can't go outside because you're going to be under 5 feet or plus of water. So clearly, if the environment is bad, if we can't control what's going on our planet Mother Earth, we can't have any economies, and we can stop talking about everything else because nothing else really matters when you get to that point. Now on to housing. Federal Reserve loves talking about inflation. It's the only thing they care about. Baby out with the bathwater, everything I've been saying. But they fought inflation the completely wrong way. And they said they couldn't control food and energy inflation. Okay, fair enough. They know they can't do that. Why keep raising the rest of the rates? But here's the problem. They have raised payment inflation on the housing market to levels previously not seen before, to and from. Give you an example. Let's say you do a 30-year fixed loan last year at 3% flat. That payment is $4,216. Let's say you do that same $1 million loan this year at 6% flat, on a 30-year fixed for that matter, for example. That payment is $59.95. That is a 42% increase in payment inflation on your mortgage. Not exactly sure why the Fed doesn't want to measure payment inflation. They're trying to fight inflation in a macro way, throwing out the micro, the individuals who have to absorb this inflation now, trying to enter the housing market. I think the Federal Reserve has this wrong, and if they don't course correct, backtrack, backpedal, admit they're wrong, whatever it is, we are going to be in for something in the next 6 months to a year that I don't want to say out loud because it's not going to be pretty. So, Federal Reserve, this little guy's advice: lay off, back off, let things shake out, let the $5 trillion work its way through our economy. You know you can't help core inflation, and now you've actually created payment inflation in housing, which is a different type of inflation that you should certainly get your stick out and start measuring. Okay, everybody, that is my show for this week. I hope you enjoyed it. As always, if you have any mortgage-related questions, please don't hesitate to reach out to me. Have a wonderful weekend, and please